We are taught to view retirement as a storage problem. You work. You save surplus capital. You store that capital in a vessel. A 401k. A pension fund. Or a government trust. When you stop working, you simply empty the vessel. It is a closed loop. A personal equation. But this story is incomplete. It relies on a misunderstanding of what money actually represents over long timelines. Because when you look at the demographics of the developed world, the math of that storage vessel no longer works. To understand why the system is straining, we must look at the ledger. Not the counter. The balance sheet. In a modern economy, you cannot save retirement. You cannot store 40 years' worth of food, medical services, and electricity in a vault. What you are saving is currency, which is merely a claim on future production. For your retirement to exist, someone else must be working to produce the goods you will consume. The money in your account is just the queue ticket. The actual retirement is provided by the labor force active at the moment you spend the money. This reverses intuition. You feel independent because you have savings. But economically, you are entirely dependent on the ratio of workers available to honor those claims. And right now, that ratio is collapsing. Today, we are going to look at the mechanical shift that has quietly moved the risk of this collapse from institutions to you. We will look at the decline of the defined benefit pension. The math behind the 2033 Social Security wall. And why the global demographic shift makes this a problem of solvency, not just liquidity. It's not hidden by conspiracy. It's hidden by complexity. Let's begin with the structural change in how retirement is funded. 40 years ago, the dominant model was the defined benefit plan. In this model, the company held the liability. When you worked, you earned a promise. On the company's balance sheet, your future retirement was a debt they owed. If the market crashed, the company had to fill the gap. If you lived to be 105, the company had to keep paying. The company held the risk. The employee held the security. Then, the system shifted. We moved to defined contribution plans, like the 401k. The logic was sold as portability and control. But mechanically, it was a transfer of risk. For the corporation, a liability disappears. They no longer owe you a specific outcome. They only owe you the contribution today. For you, it feels like an asset is created. You see a number in an account. But strictly speaking, what you have acquired is the sole responsibility for market performance. If the market remains flat for a decade, which has happened before, your retirement collapses. If inflation spikes, your purchasing power vanishes. The institutional buffer is gone. This shift was profound. From the 1980s to the 2010s, the corporate world successfully offloaded the liability of an aging workforce onto the balance sheets of the workers themselves. They did this driven by the three constraints of banking and business: risk, regulation, and profitability. A defined benefit pension is a drag on profitability and a massive regulatory risk. A 401k is simply a payroll expense. This shapes everything. It means the modern retiree is not relying on a contract with an employer, but on the assumption of perpetual asset price growth. A typical financial plan assumes a 7% annual return. But debt always grows with interest, while the real economy grows with production. If the financial assets grow at 7% while the economy grows at 2%, a gap forms. That gap is inflation. And it eats the value of the very asset you are holding. Now, let's layer the second pressure point. Demographics. This is where the storage myth truly breaks down. Remember, money is a claim on labor. In 1960, the United States Social Security system had roughly 5 workers contributing for every 1 retiree drawing benefits. Today, that ratio has dropped to roughly 1.8 to 1. We often hear that savings do not limit lending in banking. In retirement, savings do not create workers. You can have $1 trillion in the Social Security Trust Fund, but if there are only a handful of workers to tax, that money has no purchasing power. The Social Security Administration's own trustees project the reserve depletion around 2033. When the trust fund reaches zero, the system becomes purely pay-as-you-go. It can only pay out what it brings in via tax revenue that year. Current estimates suggest an automatic benefit cut of roughly 20% to 28% instantly. This is not just a government budget issue. It is a macroeconomic shock. If 74 million retirees suddenly lose a quarter of their income, consumption collapses. When consumption collapses, corporate earnings fall. When earnings fall, the stock market, where your private 401k lives, also corrects. The two sides of your retirement, the public floor and the private ceiling, are connected by the economy. You cannot have a thriving stock market in an economy where the consumer base is shrinking and becoming poorer. Just as loans and deposits are created together, economic growth and demographic expansion are linked. We have built a retirement system that requires exponential growth in a world of shrinking populations. If you want to see the future, look at Japan. Japan is the most severe case, with over 30% of its population already aged 65 or older. By 2050, that approaches 40%. In Japan, we see what happens when there are more sellers of assets than buyers. When a generation tries to sell their large family homes to retire, but the generation behind them is smaller and poorer, prices do not go up. They go down. If there is no buyer, no transfer occurs. The wealth stored in the home evaporates because liquidity dries up. Europe is following a similar trajectory. The population over 80 is expected to double by 2100. The United States is aging slower than Japan or Europe, largely due to immigration, but the trend is identical. We are moving from a world of labor abundance to a world of labor scarcity. This changes how capital behaves. In a labor-scarce world, wages must rise to attract workers. Higher wages mean higher inflation. Higher inflation means the central banks must keep interest rates higher than the near-zero rates of the 2010s. And as we know, when interest rates rise, asset prices, stocks, bonds, real estate, tend to compress. This reverses the intuition of the last 40 years. The common belief is that stocks always go up in the long run. But the long run of the last century coincided with a massive population boom. We are now entering a century of population plateau. The financial instruments you hold, the stocks, the bonds, are priced based on the assumption of infinite growth. If the physical reality of the workforce contradicts that assumption, the price of the assets must eventually correct to match reality. So, where does your retirement really come from? It does not come from a bank account. It comes from the capacity of the next generation to produce goods and services. We have shifted the financial risk from the corporate balance sheet to your personal balance sheet. We have built a dependency on asset inflation. And we are approaching a demographic bottleneck that challenges the math of those assets. Once you see it, patterns become clear. The volatility in the markets. The debates over retirement age. The anxiety about inflation. They are not separate events. They are the sound of a system trying to reconcile its promises with its physics. The math is inevitable. The variable is how we prepare for it. Silence is golden.